You may have noticed lately that you're paying more for goods and services in today's economy. Well, that's called inflation, and it's becoming a major concern for all of us. Hi, I'm Matt Carlin with Carlin Financial Group. For the best retirement information and to help make sure you don't run out of money or outlive your money, subscribe to our channel and ring the bell so you won't miss out on our future videos. Inflation can be a big concern to your financial future. After all, you've worked and planned and believe you've got enough to live on in retirement, and then boom, the cost of a loaf of bread increases, gas prices go up, and even going out to see a movie hits your pocketbook. Much harder than the year before. But try not to hit the panic button right away. Yes, prices do go up. And recently, thanks to the coronavirus, we've seen an acute example of how that can happen. According to a July 2021 article in MarketWatch, the price of a car rental in Bozeman, Montana has risen 278% since last year. $259 a day. Airfares rose 24% in May. That was compared to a year earlier, but we're still down 6% compared to their pre-pandemic levels. We've seen lumber prices soar, and prices of computers and cars increased due to a semiconductor chip shortage. Used car prices have shot up, and it's sometimes difficult to find one to purchase even if you wanted to. But try to keep this all in context. Much of this is related to the pandemic, and God willing, someday soon that won't be as big as of a concern. And I don't believe we're looking at the kind of inflation we saw in the late 1970s and early 80s when the inflation rate got as high as 15%. But all that being said, inflation is real, and we need to be as prepared as possible to deal with it. So what do you do? How do you prepare for rising costs over the years? First, stress test your financial plan. You have to do some what-if planning as you try to protect your financial futures. No one can see into the future, but what would it mean to your personal expenses, income, savings, investments if we see an inflation rate annually of 3, 4, 5% or more? What if medical expenses increase by 50% over the next 10, 20 years? These are all possibilities, but they are not certainties. But in financial and retirement planning, we have to make some assumptions or educated guesses and turn those into projections for your future. If you have a written financial plan, put it to the test and see what effects changing these assumptions could have on your future. Now, before I move on, I want to note one potentially positive result of inflation to consider, and that is that we are going to see a higher Social Security benefit this next year. As a matter of fact, an increase of 5.9%. Social Security benefits have that cost of living adjustment, and it tries to offset inflation. So beneficiaries are going to see an increase in their income that they receive every month. Previous year, the COLA was only 1.3%. Not a big help. But this year, hopefully, that will be much more of a help. Other things you can do in 2021 as we look forward is to look for opportunities when and if they come along. For instance, savings and CD rates are not great right now, so you may not want to commit your savings in those instruments for very long. It's possible we'll see an increase in interest rates, and if that happens, you can look for savings or CDs at a higher rate. You could also consider multi-year guaranteed annuities. Right now, you may find that those rates on those products that mostly range from 2 to 5 year maturities are significantly higher than current savings rates from a bank. Next, it could be a good idea to lock in a low fixed rate mortgage and low rates on other loans while you can. When interest rates start to go up, start to increase, you'll end up paying more for those types of loans in the future. On the other hand, try and stay away from adjustable rate loans because, again, with an increase in interest rates, you will almost certainly see the rates on those types of loans increase. You may also want to try to avoid investing in long-term bonds in low interest rate environments. In general, the longer the term of the bond, the more its price will fall when interest rates rise. For example, if you purchase a 30-year bond at today's rates of 2.25%, and we have inflation, and increased interest rates, bond issuers could start selling bonds at 4 or 5%. That could result in a drop in value of your original bond. A final tip, have a plan for guaranteed income for your lifetime, but keep investing in stocks for the long term. A part of your portfolio should always be focused on growth, and while stocks don't offer any guarantees, a diversified portfolio of stocks with dividends reinvested has consistently earned more for investors than the inflation rate. So as you can see, there are quite a few things to consider when we're talking about your long-term financial future. That's why it's important to remain vigilant and realize your plans may need to change. If you've got other questions, let us know down in the comments. If you'd like our help developing or reviewing your plan for how inflation could affect your financial future, you can apply to become a client using the link below. Thank you for joining me today. I hope you got some value out of this video, and if you did, please share it with your friends and family and give it a like. Remember to subscribe to our channel and hit that bell, and as always, live today, plan for tomorrow.